My name is Brett Synicky. I'm a consultant here at Sense Financial, and I've been a real estate investor and had my license for a long time, and joined here by founder and president of Sense Financial, a boutique financial firm that specializes in self-directed retirement accounts with checkbook control, and that is Dmitriy Fomichenko. And Dmitriy and I, as I mentioned, will be taking turns answering your questions today. We have some questions that have been pre-submitted at registration, but we do encourage you, as we're talking through this, sometimes you'll think of something, please put it in the chat section, and we will absolutely give some time at the end to answer those questions that are coming in, okay? So without further ado, let's kick it off.
Before we actually kick off, just a quick technical check. If you guys can hear us well, if you can see the screen, just give us a thumbs up, because we want to make sure that we can communicate clearly to you.
There we go. Thank you for that.
All right, awesome.
One more thing too before we get started. This is for educational purposes, so if you need any sort of tax advice or legal advice, we encourage you to reach out to your tax professional or the attorney that would specialize in that category.
Yeah, and also we did go over the questions beforehand, and a couple of questions were a little bit unclear. So if you do remember your question, we'll get to that, and if you want to hear the answer, please clarify it by typing it, but we'll get to that. So let's kick it off with a question from William. He's asking, what happens to my solo 401k if I dissolve my business? Brett, why don't you take this one?
Yeah, William, thanks for the question. Well, you have a couple of options. One, if you're going to remain self-employed, possibly you're just not going to run that particular business anymore. In other words, the sponsoring business of the solo 401k could possibly change. If you're going to have that legitimate self-employment activity, we can change who the sponsoring business is. So that's not a problem. You can maintain the solo 401k as long as you maintain that legitimate self-employment activity. It doesn't have to be the same company throughout. And so that's option number one. The other option is you can, depending on what you're invested in, you can still self-direct into alternative assets. So you may not qualify for the solo 401k anymore if you're not going to be self-employed, but you could transition to a self-directed IRA, and we can absolutely help you out with that if that's the route you want to go. Okay. All right. Question number 2 from Caitlin. Caitlin, thank you for asking this question. And Dmitriy, Caitlin is asking, what else can I invest in through my self-directed IRA that people maybe don't know about or don't take advantage of? And there's a parenthesis here, besides real estate.
Well, Caitlin, thank you for asking the question. And the answer to that is there is no simple answer. You can invest with self-directed IRA or self-directed 401k. You can invest in virtually anything. So you're obviously not limited to real estate. Some people have a misconception that self-directed IRA can only be invested in real estate, and that's not true. Real estate is one of the most common investments that people make using their self-directed retirement accounts. But IRS does not give you a list of things that you can do. So again, that list is virtually limitless. Instead of that, IRS tells you what you cannot do with your retirement account. And so it's important that you understand that. And as far as the investment options, IRS tells you that with your self-directed IRA, you're not allowed to invest in collectibles and life insurance contracts. So only two investments that are disallowed specifically by the IRS. In addition to that, IRS tells you that your self-directed IRA is prohibited from entering into any transaction with disqualified person. And disqualified person is yourself and your immediate family members. So for example, if you do get into that real estate transaction, if you're solo 401k purchases rental property, that rental property cannot be rented to your child, for example, or to your parents. So that's the investment by itself is not prohibited, but that transaction will be prohibited. So as long as you remember those, then you're fine. But besides real estate, you can invest in cryptocurrency, precious metals. You can invest in private businesses that are not publicly traded. You can invest in virtually almost anything. So again, hope that helps, and we'll jump to the next one, which is coming from Jay. And Jay is asking, what are the processes of withdrawing funds out for emergency? And he understands that it will be a taxable event. Brett? You are muted, so let's try that again.
Sorry about that. Don't know how that happened, but obviously I clicked on something. Jay, thank you for the question. And yes, you're not a client of ours, so we're not sure what type of retirement account you might be referring to. If you have an IRA and you take an early distribution, that is going to be subject to taxes and penalties. So seems like you understand that already. If you do that, you need to go through the custodian to take that early distribution. If you have a solo 401k, well, the solo 401k in our plans has a participant loan option where you could borrow up to $50,000 or 50% of the total plan balance, whichever is less, and use that for virtually any purpose. And instead of paying yourself or paying somebody else back, you would pay your retirement account back and continue to build up the balance of that retirement account, which is the point of it to begin with. So you are welcome to reach out for further questions. We can definitely take a call offline. I see that you're on this webinar right now, so if you want to type any clarifications into the chat, we're happy to address that as well. But that's the answer to that. And the next question comes from Omar. And Omar is asking, what are the different filings and when do they need to be filed? For example, LLC filings, 5500 or any other. And he's referring to a solo 401k.
Thanks, Omar, for asking a question. And I just want to encourage you all who are listening to us to go ahead and type your questions, any follow-up questions you might have, or any new questions in the Q&A section of the webinar here. And we'll get them after we exhaust all the pre-submitted questions. But Omar, as far as the filings, if you have a LLC, this is not specifically to the solo 401k, but there is a new law that is in place. If you own LLC or a corporation, you're required to submit that report. So be sure to do that. As far as the 401k is concerned, the 5500 EZ form is required to be filed by the end of the 7th month following the end of the plan year. For most people, the plan year is the calendar year, January through December. So if your plan year ends December 31st, you have until end of July to file the Form 5500 EZ. There's a couple of ways you can do that. You can do it online. You can do the paper form. We do provide a resource for you to help you complete that filing. Just navigate to the client portal, go to the maintenance section, and then click on the annual filing requirements, and you'll see there's a detailed procedure there for you, including instructions how to complete every single field. So that's pretty easy to do. If you want to make your job even easier, we do offer a la carte service to help you file that, so we can do it on your behalf electronically with the IRS. Go ahead and contact our office. We can help you with that. But other than that, there is a reporting that we require to do as a document sponsor, as a document provider, but you don't have to worry about that. That's something that we do every January, and your plan will be included in that report automatically. Again, that's something that we're responsible as a document provider. You don't need to worry about that. As far as you're concerned, $5,500 that is required when your plan assets reach $250,000 total plan assets. That doesn't necessarily mean that the value of your 401k is $250,000. So don't make that mistake, because if you own a property, for example, with leverage, let's say you started with $150,000 in your solo 401k, and you put that 150 down, and you ended up buying a property for $300,000. You actually obtained a non-recourse loan for $150, but the total plan assets in your 401k is $300, because that's the value of the property. Now you owe a loan, but the total reportable plan assets is $300. So you are required to file this report. And frankly, we do recommend filing this even if you're below 250. This is just a good practice, so you get into a habit, you understand how to complete. And frankly, it takes just a first filing for you to kind of get familiar with this. So complete your first report, do it ahead of time. Usually this form is released around February or so every year. You probably won't find it available in January, but typically by mid-February it is available. So you've got plenty of time to complete that. You can send it to us for review. Our team will review it, make sure it's completed correctly, find any mistakes, if any, and then next year you can just pretty much copy all the information onto the next year form. And the only information that you have to replace is the numbers, the plan assets, any contributions you made, and so forth. But the rest should be the same year after year. So again, and you also get the statute of limitation going by filing this form. So it's a good idea to do that. And obviously, if you made any contributions to the 401k, those are reported on your tax return. So remember, there are two components with contributions. The elective deferrals, those are reported on your personal tax return, and profit sharing contributions are reported on your corporate tax return or on Schedule C if you're sole proprietor. Hope that helps, Omar. And we'll jump into the next question coming from Sheila, who's asking, the 1099 for my solo 401k trust rental income received from my property management is just for us to keep a record, correct? Brett?
Yes, Sheila, thank you for the question. And that would be a yes to that in short. The 1099 has been furnished to the IRS. You have an EIN number that's tied to the solo 401k trust, and the IRS knows that that's a non-taxable entity, and so it's not a taxable event, and you should keep it for your record, just like everything else that has to do with all the investments you have and that. But it is not a taxable event, and it is just for you to keep as a record. Jacob is asking next, is there a way to pay a manager from solo 401k funds? What if the account owner is the manager? Dmitry.
Jacob, good question. So I need to understand a little bit more context. What manager are you referring to? If you're talking about a property manager who managing rental property that your solo 401k owns, then yes. If you have a property manager who manages a rental property that is owned by your solo 401k, yeah, solo 401k will pay the property management fee out of the rental income. No issues there. If the account owner is the manager, that's the problem, because account owner is considered a disqualified person to the 401k. And as such, number one, account manager or account owner, you are not required to have a property manager, a third-party property manager to manage property that your IRA or 401k owns. You're not required to do that. So you can do basic administrative functions yourself. But remember, they're basics, because as a disqualified person, you're prohibited from providing services to the 401k, and you're prohibited from receiving any compensation. So, for example, you can take a call from the tenant, and if property needs some kind of work, you can arrange for the plumber to go and fix a leaky faucet. Or if you have AC that is broken, you can find a HVAC contractor and arrange for them to go and fix that AC that is not working with the tenant. But you personally cannot go and do it yourself. So you're not allowed to be any kind of hands-on or touch the property hands-on. So it's only, you can sit at your desk and you can do that work from your desk, so to speak. So you can't do the work yourself. You'd be violating the rules. And then if you receive compensation, you'd be breaking another rule, because you're prohibited from receiving any personal compensation from a retirement account. So no, you cannot receive any compensation, but you certainly can pay a third-party property manager. No issues there. Jacob, if you, and also I'd like to add that, if it might be a good idea to have a property manager. Yeah, you're going to pay them, 7, 8, or 10% of the rent, but you can focus on other things that you do. Property management is probably not your occupation. So why bother? Why be distracted with that? Just focus on what you do the best and let other experts handle that. But hopefully I was able to answer your question. Feel free to reach out directly for any follow-up. And with this, we'll jump to the next question, who comes from Eric. And Eric asking, if my solo 401k invests in real estate through an LLC, will depreciation benefits pass through to me? Brad?
Yeah, Eric, thanks for the question. Well, so think about what a solo 401k is, or for that matter, a self-directed IRA. It's not a taxable structure, right? There are no taxes, with some exceptions with UBIT in some cases. But with the solo 401k, there is no UBIT on, and that would only kick in on leveraged real estate. There can be UBIT if the IRS deems that you're running a business within the solo 401k, but we're talking about real estate in this situation. So the only way that you would have unrelated debt finance income would be as if you have leverage. In an IRA, that will cause the UBIT tax to come into place on the portion of the income that is subject to the leverage. But in the solo 401k, there is no UBIT on leveraged real estate. So for your situation, you don't have to worry about that. Therefore, there is no depreciation benefits either, because there are no taxes to begin with. And if you do want to take advantage of depreciation, by the way, there's nothing wrong with owning real estate in your personal name to take advantage of that, and then also in your retirement account. That's not a bad strategy, but for the sake of your question, in the solo 401k, there is no depreciation in this situation.
And just to, again, to just a little bit confirm, because I think Eric asking, will the depreciation benefits pass through to me? Now, they're not passing to you because you don't own the property. Your 401k owns the property. Think of it this way. If I, Dmitry, own a rental property, can you, Eric, claim depreciation benefits on a property that Dmitry owns? Absolutely not. You have nothing to do with that property. Same thing here, Eric. Think of it this way. Your 401k is not you. You are not your 401k. Your 401k is a separate legal entity. So you can't expect to receive any kind of personal depreciation benefits from the property that your 401k owns. Eventually, you can take that property out of the 401k as an in-kind distribution. You could do that eventually. Then you can start receiving the benefits, but not while your 401k owns that. I just want to make sure that part is clear.
Yes, thank you for that. Good point. Myra is asking, if I only pay myself $20,000 annually, am I able to contribute the full $20,000 to my solo 401k? Dmitry.
Myra, I'm a little bit unclear on what it is that you're paying yourself for. Again, if you're a solo 401k client, you do need to have legitimate self-employment activity that generates earned income. And so that earned income is what determines how much you can contribute to your solo 401k plan. So there can be a self-employed income that is reported on Schedule C, or if you're incorporated, then the contributions are based on the salary that your corporation pays yourself. So if you're talking about the $20,000 salary that your corporation pays you, then you should be able to contribute most of that, but you need to account for payroll taxes, and so you got to run the payroll. So I think that's what you're referring to, but I need to double check. So if you're a sole proprietor and you're just filing Schedule C, and you're referring to $20,000 net self-employment income, again, it has to be based on the net self-employment income, not gross. You will have to subtract half of the self-employment taxes from that. But regardless what your structure is, the business structure that is, we do have a tool for you to use, which is a contributions calculator. So go to our website, SenseFinancial.com, and then under Solo 401k menu, click on a contributions calculator, select your business structure, enter the dollar amount, and it will tell you exactly how much you can contribute. So you don't have to do guesswork. Use that tool, and you will get accurate answers on this. Let's jump to the next question, coming from Julian, who's asking, I'm starting a new business. How does opening a solo 401k help me? Brett, take this one.
Yes, sir. Jillian, thanks for the question. You're starting a new business, and opening a solo 401k could possibly help you. Now, we don't have enough information to completely answer the question. Part of this would depend on whether you had any existing retirement accounts that you wish to roll into the solo 401k to invest in alternative assets. If you did, and you are starting a new business, it can make sense to establish the 401k and start roll that money into the 401k and invest it into alternative assets if that's what you wish to do. You can make contributions when your company starts to become profitable. If you don't have anything to roll into it, you don't have any existing retirement accounts, or maybe you only have a Roth IRA, which can't move currently. That may change in the future, but currently cannot roll into a solo 401k. And you're not going to be profitable for the foreseeable future because it is a new business. It may not make sense for you to establish a solo 401k. So, Jillian, I'm happy to talk to you one-on-one and just learn a little bit more about your situation. But I think we'd need just a little more info to properly guide you on this.
Good answer, Brett. Next question comes from Mary, who's asking how to make sure we are in compliance with taxes. Brett?
Mary, thanks for the question. And well, you probably have some very specific questions or a reason you're asking that, but essentially when you are making contributions, as Dmitry was talking about earlier, first off, when we establish the plan documents for you, those are IRS compliant. Okay, so that's already taken care of. Any contributions you make from the business as far as the employee deferral goes. As Dmitry mentioned on an earlier question, those are going to move over to your 1040 as either a non-taxable contribution, or if you're doing Roth, that's going to be reported as a Roth contribution, but it's going to be taxable income that you pay taxes on. On the other side of the other bucket, which is the profit sharing, the employer contribution, that's going to be reported on your corporate tax return as a business expense. And so that's the way you stay in compliance with the contributions. Now, in addition to that, as we've talked about earlier, we do encourage you, whether you have $250,000 of total plan assets or not, to start filling out that 5500 EZ form annually to get into the habit of doing it. But once you get over $250,000 of total plan assets, you must fill that out and turn it into the IRS, which of course we can help you with if you'd like, as far as the completion goes, or you're welcome to do it on your own. And our client portal has information on the maintenance section of your 401k about how to handle that. And next question comes from Fred. Fred is asking, how much IRA owner due on IRA? Can owner split out a section to live in his personal RV? Dmitry, would you like to try and answer this question?
Yeah, so that is the question that that doesn't make a lot of sense to me. Maybe I'm missing something. So Fred, if you can clarify, if you are on the call, if you can clarify this question. So how much IRA owner due to an IRA? So I'm not sure I understand that. Can an owner split out a section to live in a personal RV? Well, if you want to live in your personal RV, you can, but what are you referring as far as splitting? So again, I don't want to answer something that I don't understand. Something is missing here. So Fred, if you don't mind, just type in your question, but please be specific. Give us all the details, or better yet, contact our office and schedule your complimentary consultation with one of us, and we'll be happy to listen to you, understand your situation, your question, and then give you the accurate answer.
Okay, thank you. Jamie is asking next, can I use self-directed IRA to pay off a HELOC without taking a distribution? Dmitry, would you like to answer that?
Sure. Jamie, if you have a self-directed IRA, your self-directed IRA cannot be used to pay off a HELOC, because that will be a distribution. In order for you to pay off a HELOC, you have to take a distribution, because your IRA funds can be only used to make investments. So you can use your IRA money to buy rental property. You can use your IRA money to pay for expenses on that rental property. You can use IRA money to lend money to a third party as a private loan. Again, you can only use your IRA funds to make investments. You can't use your IRA funds to pay for personal expenses. You have to take a distribution first. So, and paying off a HELOC, you can't do that directly out of an IRA. You will have to take a distribution. Once you take a distribution, this is your personal funds. You do whatever you want to do with this money. You can use it to pay off a HELOC. You can use it for any other personal needs. Just remember that distribution will be subject to taxes if it's a traditional IRA, and penalties if you're taking a premature distribution. But the answer is no. Unfortunately, you cannot use IRA funds to pay off a HELOC. Let's jump to the next question coming from Greg, who's asking, are these IRA and 401ks best for me? Brett, you want to give it a shot?
Sure, yeah. Greg, thanks for the question. I see that I do have a consultation scheduled with you in a few days, so we'll definitely dig in a bit more on your situation, because just based on this question, I don't have enough information to guide you towards the IRA or towards the 401k. But just generally speaking, if you are self-employed with no full-time employees other than you and a spouse, you may qualify for a solo 401k, in which case that's going to most likely be our recommendation, is that you look at the 401k versus the IRA. Higher contribution limits, participant loan, no UBIT on leveraged real estate. Those are just a few of the advantages over the IRA. The contribution limit being 10 times more than in the IRA. So that's going to be the 401k. Now, if you're not self-employed and you still wish to self-direct your retirement accounts into alternative assets, then we're going to focus the conversation on the self-directed IRA. But again, just not enough information, Greg, here, but we do have that call, so we will dig in and figure out which one is best for you and guide you in the right direction.
All right, we exhausted our pre-submitted questions, and we're going to jump into questions here on the Q&A that you guys typed here. Again, just want to encourage you to type any additional questions, any maybe clarifying questions, or any new questions here in the Q&A session. Just click there on the Q&A, type your question, and we'll get to that. We should have enough time before the end of the hour here to get. We got about a dozen or so. So let's jump in. Why don't you read the first question, Brett?
Okay, yeah. Now Jay he was our second question we asked about withdrawing funds out for emergency, understanding that it would be a taxable event. So maybe this is a follow-up. I've had a solo K for about 5 years. I'm looking to do a withdrawal early. What does that process look like, and what penalties can I expect, generally speaking, he says?
Well, Jay, again, if you are over retirement age, then you shouldn't have any penalties. The 5-year mark doesn't give us your age. So if you're 35, let's say, and you had your plan for 5 years, you started at 30 and you're 35 right now, well, there will be penalties because that will be premature distribution. If you're 65, that's a different story. So depends on your age. Solo 401k is a retirement plan designed for your benefit at retirement. So if you're taking early distribution, you will be penalized. Now, if you do have Roth portion in your 401k, you could potentially take the contributions without being penalized. But other than that, the process, we do outline that on the client portal. So be sure to log into a client portal, or actually, I think you are not a client, Jay. So if you're not a client, you've got to talk to your plan provider for guidance, because we do provide that guidance for our clients on the client portal. But if you want to become a client, feel free to reach out to our office. We can take a look at the details of your situation and help you switch, and we'll help you with the process taking distribution. But yeah, feel free to reach out. Okay, next question coming from Tom, who's asking, when borrowing from SD IRA, how long do I have to pay it back before penalty? Is there a required percentage rate on the borrowed money? Brett, you want to grab this one?
Sure, yes. Well, there is a required interest rate. So it's prime plus 1% is what you would do.
Brett, that's an IRA. He's referring to an IRA.
Oh, I'm sorry. You said that. Well, you're not going to borrow from an IRA without taking a distribution. That's not an option with an IRA. If you do that, it's going to be an early distribution, or if you're over 59 and a half, you can take a distribution and pay the taxes on it if it's a traditional. The only exception to this would be if you withdrew the principal the contributions of a Roth IRA, you could do that, but that's not borrowing. That's just taking that money out.
Yeah, so the short answer to your question, Tom, is that is not possible. You cannot borrow from an IRA, period. So only can do it from a 401k.
Perfect. Okay, let me read Jamie's question. I have a HELOC I'm paying 8.5% on. Oh, Jamie is she was the question on the HELOC. Okay, I have a HELOC I'm paying 8.5% on. The money is used partially for a loan to a house flipper and partially for a note that was paying 15%. I would like to pay off the HELOC with my self-directed IRA without using distributions. Is that possible, Dmitry?
That's not possible, Jamie, as we answered that question to you earlier. That is not possible. This is your personal money. Your IRA money can be only used to make investments and to pay expenses that are directly related to the investments that your IRA owns. So this is your personal HELOC. You absolutely cannot use your IRA funds without taking a distribution to pay that off. So in other words, if you were to use your IRA money to pay off a HELOC, that will be a prohibited transaction. Your entire IRA will be considered distributed. But if you had to do that, which not a good idea in my opinion, you got to find other means to pay off the HELOC, and you got to continue to grow your IRA in a tax-deferred environment. That's the point. The IRA and 401k, those are tax-deferred retirement vehicles. They do allow you to grow your wealth tax-deferred. That's super powerful. And so it doesn't make sense, in my opinion, to take an early distribution just to pay off a HELOC. Again, find other ways to deal with that, but just use your IRA to invest and get the possible, the most possible return on your money, depending what it is that you know. But yeah, the answer is no. Tom, again, a follow-up, and we answered that. Can I borrow from a Roth IRA? No, that's not possible. You cannot borrow from an IRA, period. You can only borrow from a 401k. You can take a distribution from a Roth IRA, and the contributions from a Roth IRA come out first, so those are not taxed. But again, that's not a loan. And then Tom also adds more. What do you use as a criteria when hiring a property manager? I know they can go behind your back and raise someone's rent without owner's knowledge. Well, Tom, this is beyond this Q&A. We are talking about self-directed IRA and 401k questions here. You're talking about property management question. There are plenty of resources out there. I mean, I'm an investor. I have property managers. I dealt with property managers, so I can maybe try to give you a little bit of a guidance here. You want to look at the references. You want to see what kind of reputation property manager has. You want to read the property management agreement, but yeah, and go on Bigger Pockets. There's a lot of information there on how to find a property manager, but that's, we can really do much more than this. Next question comes from James. For 401k investments, must K1 state taxes be paid? Brett?
For 401k, James, no, there are no state taxes on the K1. That money, just as long as it goes back into the account that is owned by the solo 401k trust, then you're fine. That you just want to make sure that all expenses and all income go into, and this goes for the IRA and the 401k, that all expenses and all income go into and out of the account that's owned by the retirement account, by the trust or the LLC. But no, there's no state taxes on that K1.
Yeah, remember, James, that the income is not coming to you. Income is coming to the 401k, and 401k is tax-exempt entity. So if income that 401k receives is not taxable, it's sheltered from taxes unless it's a business income. So if you're receiving a K1 from an active business, because that's a possibility. If you're receiving a K1 from maybe a syndication investment that you made, which owns a commercial or multi-family commercial property, then that's rental income is going to be passive. But if you're investing in a business that in some kind of partnership that operates a business, and that K1 distributes portion of that business income to your 401k, there is a possibility of UBIT taxes. But it's not a state tax. UBIT is an unrelated business income tax. It is a tax that is assessed to tax-exempt entities otherwise that engage in an active business. So that will be the answer.
Okay, next question comes from Sanish. Hope I'm saying your name correctly. In a self-directed Roth IRA, if it's invested in a real estate fund that owns properties in many states with non-recourse debt, I know that triggers UBIT with the IRS. Does that also mean the IRA needs to file in each of those states? We kind of just answered this, to pay the state UBIT taxes in each of the states.
Yeah, you're not paying in the state. UBIT is not a state tax. It's paid on the federal level. You will need to file Form 990T. That's filed with the IRS, not with the state. So you do want to check with your CPA on this, because now we're getting into tax questions. We're not CPAs here. Taxes is not our expertise. So this is just a general guidance. UBIT implications probably will be there in the situation that you described, but it's not a state tax. All right, next question comes from Afshin, I believe. Unless the HELOC is from the house bought using solo 401k. Okay, I think it's a follow-up on the previous question, but let me comment here. If your 401k owns a property, it's probably going to be impossible for you to get a HELOC on that property. So far, doing this for 14 years, I have not seen any bank or lender or any financial institution being able to do a HELOC, home equity line of credit, that is non-recourse on a property that your IRA or 401k owns. So you can get a loan. You can if your 401k owns a property free and clear, you can go and get that financed and get a non-recourse loan, but you won't be able to get a HELOC on that property. So that won't apply either. I mean, technically it's possible, but again, I have yet to see a lender willing to do a HELOC and that is non-recourse on the property owned by IRA or 401k. All right, moving on to a question from Pauline. If I borrow $50,000 from my solo 401k, can I use it as a personal money to do anything I want with no penalties other than just paying my solo 401k back? Correct?
Pauline, yes, that is correct, as long as you pay it back. Otherwise, if you don't, it's going to become a distribution.
All right.
All right. Bhavini, hope I'm saying your name correctly. I'm a solo prop. Can I hire my spouse or under 18-year-old as 1099? Dmitry.
Good question. I'm a little bit unclear there. Can you hire my spouse? If you're a sole proprietor, you're hiring your spouse. So typically, if you own a business like a corporation, your corporation can hire your spouse or your a child, your daughter. Yeah, that's possible. now, even if you're sole proprietor and your spouse can technically work for you, you can put your spouse on the payroll. Now you're referring to 1099, so that doesn't make a lot of sense. So you're independent contractor, and now you're hiring your spouse to work for you as an independent contractor. Again, you're now, this is a question to your CPA. So I'm not sure exactly what your goal is, what you're trying to accomplish, but this doesn't seem to have anything to do with the IRA or 401k, and that should be discussed with your CPA. Again, it's important to understand what your goal is, what it is that you're trying to accomplish. If you're trying to maybe shift some of the income to your daughter, that's a tax strategy that can work. You don't have to actually pay them as a 1099. You can, if you're sole proprietor, you can pay your daughter just wages. But again, that's a question to a CPA. This is beyond our session here. All right, moving on to the next question from Curtis, who's asking, are the questions not being captured in the meeting? Also, will there be recorded replay? Well, I'm not sure which question are you referring to. We did answer every question that's been pre-submitted, and this is being recorded. So yes, it will be available on our website. It will be available on our YouTube channel, so you can certainly listen to a replay. All right, moving on to a question from Sheila. My solo 401k plan administrator is also a property manager, but I had another property manager to manage my solo 401k properties. If I, who owns a property management, drive around to look for AC tech to fix the AC for the solo 401k properties, I deduct the miles when I file for personal income tax for my property management expense. Well, let me handle that, since I spoke on that earlier. So it says here, my solo 401k plan administrator is also property management. So that doesn't make sense here, because the administrator for your 401k, if you have a 401k, your business is the plan administrator. Now, if your business is a property management company, you cannot deduct, you cannot do any work. You're referring to driving around looking for a AC technician to fix the AC. You can't do that. You can, as I mentioned, what you can and cannot do in the illustration that I often like to use is a blue collar work versus white collar work. So if you need a AC technician, you will not be driving around looking for AC technician. That doesn't make any sense. You'd go online and you just look up and you pick up the phone and you make a call. So there is no driving involved finding a property manager. And even if you were to drive to meet, let's say, with the property manager to speak with him about doing a work on the property that your 401k owns, there is no any kind of deductions for your personal income that you can claim by going and meeting with the technician to work on a property that your 401k owns. So I'm not sure if you understand this, but again, you got to make sure that your 401k is completely separated from your personal. So you cannot claim any kind of deductions on your personal taxes for anything related to the 401k. Everything is separated. Okay, next question is from Siraj, I believe. Is there any specific requirements for the LLC? Brett?
Well, yeah. Thank you for the question, Suraj. I'm not really sure what LLC you're referring to. Are you talking about an LLC that you own, that you run a business in, or are you talking about an LLC that's used to give you checkbook control of an IRA? We just don't know what the question is referencing. So I'm sorry, but I don't have enough info to answer that. You're welcome to reach out to our office and schedule a free consultation. We can answer the question. I just don't know what LLC you're referring to. I'm sorry. Oh, checkbook control. Okay, so he put another message in here. He's asking about checkbook control. Yeah, so to answer that, thank you for adding that clarification, Suraj. Well, it is a special purpose LLC. It's designed, its sole purpose is to be owned by an IRA. The IRA buys 100% of the shares of the LLC. You're the manager of the LLC. That's what gives you checkbook control. So all assets, all accounts, and everything are opened up in the name of the IRA LLC. And that's how that LLC works, but it is special purpose. It's not a regular LLC that you think of when you think of running a business inside of an LLC. It's completely separate and different than that.
All right, that concludes. Looks like we exhausted all the questions here that have been pre-submitted. Giving you another last chance to actually type another question here. At the end, I just wanted to mention that we do encourage questions. We do encourage questions from clients. You do want to ask questions before doing something. I always tell my clients, look, if you're not sure about doing something, then ask a question. Don't do and then ask the question. Because look, if it comes to your self-directed IRA, and if you make a mistake, that can blow up your entire IRA. So don't do that. The rules are pretty straightforward for the most part. It's either black or white. Sometimes there is some gray areas. And again, if you're in that kind of a gray area situation, if you're not certain, then check with us. We are here to help you. You don't have to wait for the Q&A. Again, if you're a client, you do have access to our team. I think most of my clients have my direct number, so you can even send me a text message and get that answer. So that there is really no excuse for you to say, hey, I didn't have the opportunity to ask a question before making that wrongful transaction. So don't do that. Ask questions. Keep joining these monthly calls that we have so that you can ask questions here and you can learn from other people's asking questions. I think those are great. Again, thank you for joining us. Thanks, Brett, for helping me facilitate this, and we will see you next time.
Thank you, everybody. Thanks, Dmitry. Take care, everybody.